think it would be unlikely that the market would not come down by 50% from its peak. The broad market, the S&P, and it would be unusual if the specs did not do worse than that. The problem is it slow or is it quick? The stimulus program left a lot of money in individual hands for buying the dip, and they have been throwing money this year, individuals. So the S&P went up 25% last year, and a lot of the most speculative stocks of 2020 were already going down. Basically the end of the golden era, or Goldilocks and three hungry bears. Everything has been different for the 20 years of the 21st century. The PEs average not just a little bit higher, but 50, 60% higher. Profit margins average 30, 35% higher than they had in the previous 50, 60 years. Everything seemed to work out. If you have to own US stocks, you should own high quality stocks that are in good financial shape, because this can always spiral into something of a financial crisis. They often do. I would emphasize, in general though, non-US stocks. And quite a few countries, as I said, are not that bad. The bubble in the US is eerily similar to the 2000 tech bubble. It's led by the NASDAQ, it's led by the specs. 2000, the specs underperformed all year and stay out of trouble. Make sure you don't buy expensive markets, expensive stocks. Emphasize value, cheapness for what you get. Hunt around for the cheaper countries, hunt around for the cheaper stocks within those countries. Carry some cash reserves. There'll be perhaps some very nice buying opportunities. And whatever you do, get rid of this fear of missing out. This terrible lust to participate in profit making that comes along at the end of every one of the great bubbles. It is incredibly seductive, very hard to resist. Been there, done that myself a few decades ago, made a fortune and wiped myself out. Very salutary. And I would wish on most of you that you avoid it.